you got a new way of looking at business cycle, really. Okay, so instead of talking about ups and downs, in your book you talk of something else. Can you explain us what all this is about?
I was grappling with the question of why cycles occur, why things don't just grow at the trend line rate. And I tend to think of them as excesses and corrections. So in a should world, things should grow at the trend line rate, but sometimes people get too excited and they make optimistic decisions, and those optimistic decisions cause a deviation from the trend line to the upside. Eventually, things get too high. It could be the price of a stock relative to the fundamentals. It could be the amount of productive capacity relative to the need. But when the parameter gets too high relative to the trend line growth, then it has to correct back down in the direction of the trend line, or even below it if the correction gets carried too far. And then, rather than ups and downs, I'd rather think of excesses and corrections.
The question is, how do you try to forecast those black swan events, I would call them, you know, the turning points?
Sure. Well, I think, for example, if you look at the U.S. economy today, it's in record territory. We're in the 11th year of an expansion. We've never had an expansion of more than 10 years before. Is that dangerous? Does that mean that a recession has to happen soon? And if so, will it be a difficult one? I think that we have not had great excesses in this expansion, and we haven't had too much productive capacity built and too much optimistic decisions made. And as a consequence, I think we don't have to have a powerful correction or recession. So I think that's putting that thinking to work.
So you expect the economy to grow and the market to grow for some more time?
Well, there can be a recession anytime. It's very hard to predict these things. But the important thing is that I don't think it has to be a painful one. I think because we've had moderate on the upside, I think we can have moderate on the downside.
Oaktree did the opposite of what people did in 2008, right? Yes. So can you tell the rationale of this decision?
Well, one of the values which is very important to us in our process is called contrarianism, which basically means doing the opposite. Everything in human psychology conspires to make us do the wrong thing at the wrong time. When things go well for a long time and asset prices are highly elevated and everybody's made money and everybody feels great about the process, then the euphoria tends to get people to buy at high prices. And the reverse, when things have gone poorly for a long time and everybody's lost money and everybody feels terrible and everybody's depressed, that tends to make them sell. So in other words, human nature makes us buy high and sell low. The goal is to buy low and sell high. So we must do the opposite of basic psychology. We must be contrarian. Now, it's important that nobody think that merely doing the opposite of others is a success formula, because it's not enough to say, well, they're doing A, I'm going to do B. Rather, you have to say, they're doing A, why are they doing it? What's wrong with doing A? What should they be doing? I'll do that. It's a much more laborious thought process. But in truth, at the extremes, when other people are euphoric at the high and depressed at the low, it's very important to be contrarian.
Technology, in a sense, can help smoothing the let's say, the boom and the bust, right? Maybe, at least everyone hopes so. How do you see technology, the use of technology into finance?
Well, technology is coming in gradually. We've moved from active management to a good deal of so-called passive management, where machines manage the portfolios according to set rules. We have algorithmic investing, where computers look for deviations in historic relationships and can take advantage of them, small deviations, quickly. And one of these days we'll have artificial intelligence and machine learning. So the good news is that computers can do a lot. They can handle a lot of data. They can do it fast, they can do it without arithmetic error, and they can do it without emotional error. And you know that the computer's not going to buy because it's too excited at the top or too depressed at the bottom. And so, in many ways, computers will be able to do better than people. But I don't think they'll be the ultimate in investing, because I don't think that computers will be able to make subjective, qualitative judgments about the future. The example I use is, can a computer sit down with somebody and figure out if he's Steve Jobs? I don't think so. Of course, not many people can do it either. But so I think that computers will be able to do what most people can do, better, but not what the best can do. I like to believe that there will still be a spot for the best investors.
What would you say to a young student, a young person, a young student that is willing to invest their time into studying those material, I would say, finance, economics, behavioral economics? What would you say? What should they study?
I think the great thing is, for me, that these things are not sciences. The nickname for economics is the dismal science, to the extent that it's a science at all, but I think it's not. In science, there are certain immutable laws, and if you conduct the same experiment, you get the same result. That's not the way it is in economics and investments and in the business world, because we have too many extraneous events occurring. We have psychology and we have randomness. And you put all that together, clearly experiences cannot be reproduced. Now, some people will look at that and think that's a bad thing. They're frustrated because of the vagary of the situation. I think it's a good thing because it's exciting. Every time in investing, there are differences. So we have to be flexible, we have to be adroit, open-minded, and we have to try to figure out the differences and use them to our advantage. I think that for a young person, if you like dealing with unstructured, variable problems, I think investing is great.